Hello, it is Lon Welsh at Ironton Capital, and thank you for joining me today to talk a little bit about the National Diversified Fund 10. Would you like to get more diversified in your portfolio or your self-directed IRA with more passive, diversified real estate investments? How many of you are active landlords that are tired of working with tenants and you'd like to get off the 1031 exchange treadmill and go from being active to passive real estate while managing your capital gains exposure at the same time? And how many of you would like to have a targeted IRR in the 16 to 20% range over a 4 to 6 year term, plus the option for some incremental depreciation? Well, that's what we're here to do today, is to provide you with what you've been asking for. First, a quick note from our attorneys. There's a lot of confidential information in here, so you're welcome to share this with your financial team, but please don't distribute it beyond that. Any involvement in this sort of investment involves a high degree of risk, so you'll want to consult with your financial planners to make sure it's a good fit for you. Nothing in today's presentation should be construed as an offering of an investment opportunity. We do have formal legal documents that are the investment. We're very glad to share those with you when you are curious about that. There's a lot of forward-looking statements in today's presentation. Will, may, should, expect, plan, seek, intend, anticipate. These are all based on our best estimates, our analysis of the market, what we've heard from our sponsors that we're investing in. And finally, there's a lot of company-sourced information in here. So that is information that we do our best to double check and validate, but of course, as always, we're somewhat at their mercy of giving us the full picture of what they're working on. So when you leave the heavy lifting to the experts, you'll notice that you become happier and that you can focus more on your family and your hobbies and your charitable concerns and not be as distracted with trying to figure out where to place the next tranche of real estate investment. So what we do at Ironton is unique. We focus on serving accredited investors who are usually underserved by other wealth managers. We don't have like a $10 million net worth minimum or anything like that. We have industry expertise in real estate. All three of us on the investment committee have spent the majority of our careers, well over 20 years each, looking at investment property and investing it in ourselves. And we invest with you on every one of our projects, and you need to be an accredited investor to participate in the fund. So working with an expert just makes life a lot easier for investing. Most people will start their real estate journey as a project sponsor themselves. So they select and manage the project, they find the funding, they manage the property financials and the property manager and the tenants and then the eventual sales process. And a lot of people stop because it's a ton of work. It's not always entertaining. It does get to be a bit of a distraction. And if you decide that you want to sell and do a 1031 exchange to manage your taxes and get a bigger property, sometimes it just compounds the frustration. Many of us on this call probably have been there. So a lucky few have become limited partners where all they do is choose a passive diversified fund and then they sit back and deposit the returns. And that's all made possible by the general partners like Ironton who step in to be the gap between you providing the capital and the sponsors doing the work. We do all the heavy lifting, monitoring the markets for the best opportunities, networking to find the best sponsors, doing a lot of due diligence to try to figure out which ones are the best, and then negotiating the best deal for the limited partners and ourselves so that we can get much better deals than we can on our own because we have so many more dollars that we're working with. So that's what we are here today to share with you. So what's my background? If you have not been following us for a while, I worked in corporate finance for a couple of years. I worked as a strategy consultant for 8 years at Deloitte and Accenture, and I've been in commercial real estate for the last 20. I've got a cumulative IRR of over 20% a year over the lifetime of my investments. A lot of that really was informed by my work running what became the largest independent brokerage in Colorado, Your Castle Real Estate, which I built from scratch. We have about 750 agents, and we do 3,000 to 5,000 deals a year. We've also ran a title company. So what was great about that is usually in a typical year, 15% or so of those deals, so in the high hundreds, sometimes close to 1,000, would be with investors. And I'd be able to talk to our agents and talk about their clients' investing projects, learn about the assumptions, why they were optimistic, and then 2 or 3 years later find out how did they turn out. It's a very, very practical way to learn a lot about what works and does not work in real estate. Brent Geyer is our CEO and also on the investment committee. Deep experience in land acquisition, land use across multiple states. He's been a landlord for 15 years and has completed a lot of transactions. Richard Landry came to us from Goldman Sachs, also was the chief financial officer of a multifamily value-added private equity fund. So I'm very grateful to have these two guys helping me out along the process. So the target rate of return for our projects here is to be somewhere in the 16 to 20% per year range. So if you put 100,000 in, we'll give you 100,000 back, and approximately 90,000 of profit on top of that is the target. Of course, nothing is guaranteed, so you'll want to review all the detailed financials on that. The goal would be to get most of your initial capital back after 4 years, with most of the profits in year 5 and 6. We do have one investment out of the overall portfolio that might last just a year or two beyond that in the conservative case, but we're hoping it'll go a little faster. There isn't any liquidity in this, so once the money is tucked away, you won't have an option of getting it back till we're complete. And from a tax advantage standpoint, there is an option for accelerated depreciation, and I'll talk about that in a little bit more depth later in our call here. So the thing that I think is most exciting about what we do is the 4 pillars of diversification. So we diversify in 4 important ways to diversify your risk. What I commonly see a lot of our investors' trajectory is they were a landlord on their own, they invested in a syndication or two, may or may not have had a good response from that, and now they're looking at us. The problem with the syndication is that you're not diversified. You usually just have one sponsor, one location, one project, and if anything happens, there's nothing to backstop it. What we like to do is try to be in at least 10 different states with any given portfolio. We're across multiple asset classes, so it's usually about 2/3 multifamily and residential, and the rest in industrial and hospitality. About half of our work will usually be value add, and half will be new build. And then we try to have at least 10 sponsors with about 30 different buildings across the entire investment portfolio. So these 4 pillars are how we highly manage risk with lots of layers of diversification, and hopefully that makes a lot of sense. Here's the track record that we've got with our multi-asset funds. We're talking about our 10th fund today, and we'll be running that probably through sometime near the midpoint of July of 2025, and then we'll launch Fund 11 shortly after that. You can see our prior funds where we initially thought they would be at and kind of where they're tracking to right now. So here's the 8 investments that are going to be in NDF10, and this is the final slate. We may need to adjust the amount of dollars allocated to some of these a little bit to balance out how much we raise from you, but this is the 8 investments that you're going to have, and I'm going to cover all 8 of these in detail today. So I'm very excited about this. The midpoint scenario that we see at the moment is about a 19% IRR, internal rate of return, for you, the limited partner, after all fees and expenses. You can see that the item 7 on there, square on 12th, the target return for that is to be wrapped up in 2 years. If you take a look at item number 2, that's PFD, our target on that is about a 3-year horizon, and most of the rest of these are somewhere around the 5-year range. So here's the expectation of how the cash flow timing will work. If you do a hypothetical $100,000 investment, you'll probably have most of your capital returned by 2030 is our expectation, with a large lump of the profits in 2031 and then the last little tranche in 2023. This is a conservative case. I hope that it will accelerate a little bit. So we'll be in at least 10 different states. This is our current understanding of where the projects are most likely to be at. So let's get started. So the first one on here is called Hill Point, and this is one of my most favorite sponsors I've really ever had over time. If you think about the continuum of multifamily, on the low end, you've got subsidized housing by the government for people who are economically disadvantaged. On the high end, you've got these AA luxury projects, which are built primarily in downtown and very super nice neighborhoods. And the middle point is workforce housing for police officers and school teachers and the people who drive your fire trucks. They're looking for clean, safe, reliable housing without a dog spa or any unnecessary frills. And less than 10% of the new apartment construction in America is in the workspace, in the workforce housing space. Most of it's in the luxury space. So these guys were able to figure out how to build at a very attractive price and put on a pretty nice looking product. I'll show you a couple photos as I talk about this. So the people who run this fund, their background was in student housing, which was very cookie cutter. So what they decided to do is they settled on one 2-bedroom, 2-bath, about 1,100 square foot floor plan, and every single one of their units in a 300 unit community is all exactly the same. In our fund that we'll be investing in, there'll be somewhere between 20 and 25 of these 300 unit communities, and they're all exactly the same. The buildings are either 12, 24, or 36 units, sort of stacked like Lego blocks, and they just arrange them depending on the site plan. And then they've got a common clubhouse design that they like to use. It's the same everywhere. So if you've ever done real estate development personally, like I have, what you'll find is that what the architect draws up and what you actually build in the field aren't always perfect. There's always problems that come up the first time that you build a new set of blueprints. And what's great about these guys is that they're recycling the same blueprints over and over and over again. So the wasted time that you experience when you realize, gosh, these stairs are off by 2 inches, we're going to have to do something different or else we're not going to pass the code inspection when the city inspector comes out, all these problems have already been ironed out. When you take a look at a typical new luxury build product, it wouldn't be very unusual for them to have something between 15 and 20 different floor plans between studios, 1, 2, and 3 bedrooms, and the 2 bedrooms would come in 5 configurations, the 1 bedrooms would come in 7 configurations. Every time you got a variation in the configuration of the floor plan, there's more complexity in the blueprints, and it's harder for the field crews to figure out the first time how to build it, and there's more possibilities for mistakes to come in. By only having one floor plan just repeated over and over and over again, it drains all of that complexity out of the process. Most of the materials that can be sourced offshore are, and they're bought directly at the factories at a very, very deep discount. So what's nice about that is that you can buy your faucets and sinks and light fixtures and the luxury vinyl tile that you see on the floor, the cabinet packs, the appliances, all sourced offshore direct from the manufacturer at a very deep discount to what you could buy the things for here in the States. Since all the floor plans are the same, you get great buying power. You've got the exact same cabinet package in every one of the bathrooms. You've got the same kitchen cabinet package and matching countertops. You only have to fabricate one blueprint and it's just done over and over and over again. Then you ship them all to the United States and off you go for building these things. The last cost advantage that these guys have is that there's not a general contractor layer. The sponsor actually gets the actual work crews to work for them directly, and they basically take the middleman GC part of it and they split that. They give half of it to the work crews as incentives, and then they keep the other half for us to make our project more profitable. So the work crews are extremely loyal to Hill Point because the things that crews hate is when the materials aren't on site and they can't build when they're supposed to. The plans don't make sense, and they've got to have their guys standing around getting paid while an engineer and an architect try to argue about how to solve some particular problem on a floor plan. All that's eliminated. They get paid per unit. They can build lots and lots of units really quick because they've built them all before. And it just leads to massive efficiency gains and also a really great advantage in how fast you can build things. So these are in the Sunbelt states. We like those overall because there's still very high population growth. They're very much oriented in favor of the landlord, so if you don't pay your rent, you have to leave. Sounds like something you'd take for granted, but you'd be surprised in a lot of states that's getting more and more difficult. And if you've got good job growth, that means there's a lot of demand for housing. So the goal on this is to be a little bit over a 20% limited partner internal rate of return. Their prior projects have done a little bit better than that. These guys usually are able to do refinances somewhere in the midpoint of their project to return capital too. You may not get all of your capital back, but probably 60 to 70% is what's happening in the prior fund. All right, PFD is our sponsor that we use for the medium-term income fund. So they invest in medical receivables. So we'll put a portion of our fund into PFD. And the reason for that is that if we have an unexpected capital call from a sponsor, rather than having to bother you to fund a capital call, we've got some cash set aside making a good return to be able to to fund that. And if it turns out there's not any capital calls, which of course would be our hope, then we'll use it to pay any fund fees that come up. And then if we don't use it for that, then we'll just return it back to you guys. The actual return on this is higher than this. It's just the timing of how it's invested leads to the 8%. It's an accounting anomaly on that. If you're not familiar with our medium-term income fund, they invest in medical receivables. So if two people get into an auto accident, maybe you're State Farm and you're with Geico, there might not be clarity about which of you is at fault and who's going to have to pay for it. Meanwhile, the doctors and the clinics need to get paid. So what our sponsor does is they take over all of the paperwork process for the administration of that insurance claim, which is really what the doctors are most excited about, getting out of the paperwork business. And then they'll also advance about a third of the value of the claim. So if it's a $35,000 medical bill, they may advance $10,000. And that is what the core of this fund is. We really like it because it's not correlated to the stock market or interest rates or real estate or wars in overseas. It's just something that happens because people get in car accidents every day. So that's where the cash will be stored. CVC is a manufactured housing specialist. So you can see that they build residential, things that look like mobile homes. They do self-storage, but they're all manufactured off-site. This is the only fund that was reasonably likely to last more than 5 years. It could be 6 or 7. And the target rate of return for you after all of your expenses is about 19%. So they also will do some acquisition and repositioning of underperforming manufactured house communities and self-storage facilities, as well as do some construction if that's needed to augment the community. Waverly-on-the-Lake is in Michigan, and this is a very large residential community on a gorgeous lake, and they're going to be renovating the units, so you can kind of see some before and after mock-ups of what they plan on doing, as well as they've got a pretty nice receipt of cash from the local utility to upgrade all of the HVAC systems. So it's just over 1,000 units in Bellevue, Michigan, just under 100 acres and 40 buildings. There's a pretty strong opportunity to raise the rents up to the market rates after we get these renovations done. And there should be a decent amount of depreciation that's thrown off by this project. So we're very excited about this value add. It's a sponsor that we've worked with before. They've got a pretty deep track record, and it should be a very good project. Echo Suites is a hospitality project. So what we like within the hospitality sector is the extended stay market. The reason for this is that about 20% of the room nights in America are extended stay, and that means 7 nights or more, but only 10 or 12% of the overall capacity for hospitality is configured as extended stay. And by that, you've got a cooktop and a refrigerator and the plates and dishes and things that you would need to be able to not have to go out to eat every night, actually make some meals within your hotel room. So this mismatch between supply and demand is very exciting to us, because these entry-level sort of extended stay places have very high occupancy rates, and they also tend to do better than pretty much any other segment within hospitality throughout the entire economic cycle. And the reason for that is that it's not really discretionary. So if you take a look at a luxury hotel and spa in Hawaii, if the economy is bad, a luxury traveler might decide, we're going to downgrade to a cheaper property, or maybe we're just not going to go. We're just going to stay here locally and do a staycation rather than going out. The typical use case for the extended stay entry-level product like Echo Suites is, you remember last fall, there was 2 hurricanes that hit Tampa, Florida, and they had to import electrical construction crews from multiple states down to Florida for months to rebuild all the electrical infrastructure afterwards. This is the type of place where they're going to stay. That's not elective. That the electrical grid's got to get back online as rapidly as possible, obviously. Another use case for this is visiting nurses, but surprisingly enough, visiting nurses aren't the only medical people who travel around quite a bit. Medical students working on a fellowship will often go to visit a neighboring university to study with a particular specialist for a month or 2 or 3. Or there's all sorts of other people that will go for an extended period. Another use case for this is you have people who are relocating from one city to another, and they don't want to commit to a neighborhood and buy. They want to like just rent for a short period, figure out which neighborhoods they like, and then buy a house. You also have people that are going from one house to a new one. Builder promised, hey, my new house is going to be done on date X. They sell the old house. Builder blows the deadline. Now they have nowhere to live. This is where they land for a couple months. So we like all these demand drivers because they tend not to be tied to the economic cycle. This one is going to be probably about a 17% rate of return. We put in a 4 to 6 year hold. The other hospitality projects like this that we've worked on are probably going to go faster than that, and I hope this one will as well. We like to Echo Suites, if you're not familiar with it. Wyndham is the large brand that owns it, so they can drive a lot of traffic to it. Wyndham actually is the world's largest hotel franchising company, even bigger than Marriott, which is drives a lot of brand power to keep these things full. What we like about this, there's 2 or 3 competitors in this market where this is going to go up, and I believe, I have to go take a look, I think one's 10 years old, I think one's 18 years old, and if you're going to be bringing the same product in the same geography and yours is brand new, it's not going to be tough to take market share from the older, not as sexy looking product. Okay, EastX 59 is an industrial project, and I am very excited to be part of this. So Provident is the sponsor, and they are one of my favorite sponsors I've worked with. They've done a very good job of delivering very good projects with strong returns, and they often outperform their results by quite a bit. So this one's going to be in Houston, Texas. It's an A-plus industrial facility. Just as background for Provident, if you're not familiar with them, they've completed just under $6 billion of projects over their lifetime. They're currently managing about $3 billion, and they've built 15 million square feet of industrial. So this is very much in the wheelhouse of what they like to be able to do. So this is located adjacent to the Port of Houston. So I had to get educated on this as I wasn't familiar with this, so I'll just walk you through it briefly. The Port of LA, which is one of the largest inbound shipping container ports from everything that we receive from Asia that we import, is pretty congested and beyond capacity in some facets of its operations. So historically what would happen is you'd unload the shipping containers off a giant boat in Los Angeles, and they would clear through customs. You'd unload and sort all the boxes inside of the container and then ship them out again. That's not practical to do anymore. So what happens now for some percentage of those shipping containers coming in on the West Coast is they come off the boat, they get put on a train, and they're shipped right to an inbound port somewhere else. And the largest inbound port is in Houston. So there they'll clear customs, they'll be unpacked and resorted, then shipped out to wherever on the East Coast, most likely, that they need to go to next. So the Port of Houston is growing very rapidly, and there's definitely a need for more of this type of industrial capacity there. So we think we've got the right product in the right location, and this will probably lease up pretty quickly. Target of 19%. Historically, they've done better than their projections on most of their projects. Square on 12th. So Square is the name of this residential real estate developer. They do urban infill in Washington, D.C., pretty close to the core of the downtown area. So DC's got some pretty relaxed zoning where you can oftentimes knock down a relatively large house on a lot and then put up a condo with 12 or 14 units. And they're very profitable projects. So some of our earlier funds, we've got some investments with Square, and we had the opportunity to invest in this one. So what happened here is at the time, these photos are probably, I guess, 8 weeks old when I flew out there to go see this in person. They had a lot of their capital tied up in this construction project. They found another land purchase deal that was really exciting, and they needed to get some of their equity out. So they came to us saying, would you take out some of our equity so we can go get this next opportunity, which we'll probably be investing in, I hope, in Fund 11 or 12. So we were able to do that. So instead of us being at pre-dirt where we have to knock down a building or at dirt, the building is already like at the framing stage 6 weeks ago. So they're probably putting in the mechanicals now. So that's why this will probably be such a fast 18 to 30 month hold time. We're projecting about a 19% rate of return with these guys. And I really like the work they do and the product they build. It looks fantastic. They're really good to work with. So the Missouri 4, this is a basket of about 4 not about, it is for residential apartment units around the Kansas City area. So what's great about this is earlier we talked about the spectrum of multifamily investment, and on the low end, there's subsidized government housing. Sometimes it's called LIHTC, Low Income Housing Tax Credit. So what this developer did 29 years ago, same family still owns it, they've never sold it. They built these new units, 176 units across 4 communities, signed a LIHTC contract with the local government. So they said, we're going to rent these below market in exchange for a huge bundle of tax benefits and subsidies from the government. And it's a 29-year commitment. What we think happened is that the gentleman who was the developer is pretty old, probably had some sort of a health event, no longer able to manage the properties. Now, most likely, his spouse is managing them, which I'm sure she's also older and not very excited about this. And the kids don't want anything at all to do with managing 176 units. So they just wanted to sell the property relatively quickly. So we paid a fair price for it based on the low rents that are currently in place. And we gave notice to the city saying, hey, we're 29 and a half years into our 30-year contract. We're not going to renew it. And we just have to do a light renovation on the units, raise the rent several $100s to market, stabilize it, and sell it. So we put a 5-year hold on this, but there's a decent chance we should be able to do a little faster than that. To be conservative, we put a 17% rate of return after all the expenses, but this team's done 45 other renovation projects like this, and most of it has been in this market. Most of those projects have done a little better than that, so I'm optimistic we'll do a little better on this one as well. Very easy to explain, very easy to understand, just a very straightforward base hit project. So that's it. That's what we're going to have in Fund 8. Normally, when I'm doing a wrap up, I would say, if we have any adjustments to the fund, we'll do another update call, but this should be it. The only thing I don't know is exactly how much money we're going to raise. If we end up raising a little less, we'll probably make the Hill Point allocation a little smaller. If we end up raising a little more, we'll increase Hill Point a little bit, sort of as the shock absorber to balance out the fund. So here's just the summary. We're targeting a 16 to 20% annualized return, 4 to 6 years. The CVC project could go a year or 2 longer. Most of the rest of them I expect will be faster. The preferred return situation. So there's 2 share classes. The A share class gets a slightly higher preferred return of 8%, and it gets none of the depreciation. So you'll want to talk to your CPA, but if you're a typical W-2 employee that's not investing in real estate, or if you're investing in your IRA or a self-directed 401k, the most likely situation is that you would not be able to use the depreciation. So for you, getting the higher preferred return is probably the desirable answer. Some of you on the call will be landlords that are thinking about selling a rental property, and you're going to be incurring a capital gain and depreciation recapture. Again, talk to your tax professionals, but the depreciation we can allocate to you in the B share class should be able to dollar for dollar offset the capital gains and depreciation recapture you're facing from the sale of your property. So for you, that's probably the share class that you want. We're estimating somewhere in the range of 30%. So if you put $100,000 in, with the current tax law as in place right now as I record this, we think you'd probably get 30% or $30,000 of tax write-off to offset your capital gains. The first time Trump was in office, he did a tax reform package, and they gave us some options to greatly accelerate the recognition of depreciation and losses, especially with real estate. And that is in, as I understand, the current version of the tax bill that's being negotiated in Congress. So I wouldn't want you to make a decision based on what Washington may or may not do, but at the moment it looks like there's a decent chance that we'll be able to offer you a lot more than 30% write-off in the first year. So how does the carried interest work? So the first job is we've got to pay all of the deferred preferred returns. So odds are there won't be any cash distributions in year 1 or year 2. They'll probably start in year 3, other than Square. That'll probably be done in 2 years. So odds are we won't be keeping current on the preferred return for the first couple of years. So those will just rack up. They don't compound, but they do definitely add up over time. You have to receive your preferred return before anything else happens. And then it's a 72-28 split. until we get to a cumulative 20% annualized return. And then after that, it's 70-30. And then if we get above 30% on any given project, it'll be a 60-40% on the part after the 30%. We used to have some ratios of fees in here. The Securities and Exchange Commission has told all of us that they prefer for us just to have it just be in the percentages, not to have fees. So we've adjusted it. If you've been invested in our earlier funds like Fund 5 and 6, the math works out pretty much exactly the same with what we have here as to what you did with your economics in the earlier funds. Just changed it to make it compliant to the regulations. We do invest along with you. There's a one-time acquisition fee of $33,000, and that's just prorated among all of the people who are investing. And then the annual management fee is $66,000. Okay, so before Ironton, I've got a couple of testimonials here. My retirement asset performance was inconsistent even with professional management. Many of you on this call are probably in the stock market. You've had a lot of wild gyrations so far this year. So I've got confidence in the leadership team and like the stability of real estate, and I'd like to recommend their funds for families and friends. So thank you for these guys for the very kind words that they've given to us. So the satisfaction guarantee is this. What will happen when we finalize all of our documents, we'll send this out to you, and then you're going to have 10 business days to review the material with your entire financial team. And if you're not happy, we'll just rip up your contract and give you your money back. You're going to be stuck with me for the next 5 years. I want you to be as excited about these projects as I am. And if you're not excited, then that's okay. It's certainly not going to hurt our feelings if you want your money back. Amazingly enough, cumulatively, we've only had that happen 4 times. Okay, how do you fund this investment? So you can do cash, you can do a self-directed IRA, and if you need any help with that, the people on our onboarding team would be happy to help you through all the steps. It's not really that complicated. You could do a line of credit on your rental property before you sell it. If you need bank referrals for people that'll do second mortgages on investment property, I can put you in touch with people who can do that for you. HELOC, home equity line of credit. So there's a lot of ways you can fund this investment. So you do need to be an accredited investor. So you need to meet one of these criteria. So if you're a single household and you've got income over $200,000, or if you're a double income household over $300,000, or if you've got investable assets not counting your primary of over $1 million, any one of those 3, you're accredited, and then I am legally allowed to work with you. So the next steps are set up a call with us. You can go to irontoncapital.com/book now and set up a 15-minute call with our investor relations team, and we will answer all of your questions that you've got from watching this. If you haven't gotten a copy of the legal documents yet, we're happy to share all those so you can have those be reviewed by your team, and then we'll just help you with the next steps from there. Thank you so much for your time today, and we are excited to work with you.